for prices, 44% said they saw them declining, 38% stable, and just 20% increasing. Now, again, all real estate is local and market fundamentals are therefore different based on location, of course. Still, the trend is definitely for lower prices. And 89% of our agents reporting having at least one seller who decided to cut their price last quarter. That really shows how kind of over-optimistic sellers still seem to be despite all the uncertainty in the economy and a slowing housing market. Now,
there is a number that the real estate industry does not want to say out loud: 35%. That is how much home prices across America would need to fall, according to research from Realtor.com, for housing to return to the level of affordability that ordinary Americans experienced before the pandemic. To restore housing to pre-pandemic norms, one of three things would need to happen.
Now, here are some of the highlights from Q3, when the average rate on the 30-year fixed mortgage was mostly on the decline, but moved up mid-September. Now, during that time, 49% of real estate agents we surveyed said it was a buyer's market, meaning that buyers had the advantage because homes weren't selling quickly and supply was sufficient. 30% saw it balanced, and just around 21% saw sellers with the advantage.
Mortgage rates would have to fall to 2.65%, median household income would need to rise 56%, or home prices would need to drop 35% to a median of roughly $273,000 from around $418,000 today. None of those scenarios are likely on a national scale in the next few years. Everyone in the industry knows this, and so the official line has been no crash coming, prices will soften gently, everything will be fine. But here's what they are not telling you loudly enough. In dozens of specific American cities, that correction is not coming. It is already here. It has already started. And Zillow's latest forecast, which projects home price declines in 309 out of 894 metro areas it tracks through March 2027, is showing you exactly where the floor is giving out beneath homeowners' feet.
The average income for monthly home payments is now down 29.3%. First year that this has dropped under 30% since 2022, so that's good news. 30-year mortgage rate average is listed at 6.3%. That's down from 6.6%. And existing home inventory is set to go up by 8.9%.
This is Bricks Market. Today, we are going to show you the 35% math, why it matters, and which cities are leading the collapse right now. Subscribe to Bricks Market for weekly breakdowns of what is actually happening in the U.S. housing market. Not the spin, the data. The 35% number, what it actually means. Let's start with what that 35% figure is and is not. A Realtor.com economic research analysis found that in order to restore housing affordability to pre-pandemic levels, when the typical mortgage payment consumed about 21% of median household income, home prices would need to fall 35% to a median of around $273,000 from today's roughly $418,000.
Those are the people who have to buy, whether it's having a baby or moving for a job or retiring or downsizing.
Still, of the real estate agents we surveyed in Q4, more said it was a balanced market rather than the buyer's market they were seeing in Q3. That's likely because consumers became less confident in the economy.
The analysis also noted that alternatively, mortgage rates would need to crash back to 2.65%, or median household income would need to explode 56% upward to $132,171. Economists broadly agree none of this is happening anytime soon. What the 35% figure tells you is something important about the structural reality of the market right now. It tells you that the gap between where prices are and where they need to be for normal people to afford homes is not a rounding error.
The housing market remains a bit of a challenge for buyers. And with home prices having run up so much since the pandemic, even when rent prices we're seeing as an increase recently, less than home prices means it's better to rent than to buy in many markets. That said, Zillow Group's results in Q1 grew against that challenging market, up 13% in Q1, with our for-sale revenue up 8% and our rentals revenue up 33%. So even though it's a tough time to buy and it's getting more expensive to rent, you're seeing folks able to do it, and you're seeing them increasingly turn to services like ours to get it done.
It is not a percentage point or two. It is a canyon Today, the typical mortgage payment consumes more than 30% of median household income, compared to 21% before the pandemic. The financial pressure this creates does not disappear because nobody wants to say the word crash. And here is where it gets important. Because while the 35% drop is not happening nationally, there are specific markets where prices surged 60%, 70%, even 73% during the pandemic boom. Markets where buyers stretched every dollar they had to get in. Markets that are now correcting, and correcting hard. According to data from Moody's Analytics, tracked by Resi Club, markets including Naples, Austin, Punta Gorda, Cape Coral, Fort Myers, and Northport, Bradenton, Sarasota all saw home prices surge 69% to 73% from their pre-pandemic levels to peak.
Buyers hate uncertainty, right? You saw that when rates were volatile. You're seeing that now with economic uncertainty. But the challenge for buyers and the affordability challenge is really an availability challenge. In the for-sale market, we are probably 4.5 million homes underbuilt. We've been chronically underbuilding since the global financial crisis. And so that has been this accumulated deficit we've been feeling. And now what exacerbates that problem is lack of existing homes coming online as new listings, as sellers feel stuck and in their mortgage rates.
The math of what a 35% correction looks like in those cities is terrifying for anyone who bought near the top. What Zillow's new forecast is actually saying. Now let's talk about what Zillow published in its most recent home value forecast, because the headline number hides a much darker story underneath it. Zillow's updated forecast projects 0.0% change in national home prices from March 2026 to March 2027. Flat. The media reports this as stable. But here is what that flat national number is concealing. Out of the 894 metro housing markets Zillow tracks, 309 of them, more than 1 in 3, are forecast to fall in price over the next year. The 572 markets still projected to rise are keeping the national average barely above zero. Take those out, and what you have left is a map of decline that covers a huge swath of America, concentrated in the Sun Belt, the Gulf Coast, Texas, and Florida. Zillow's own data is showing a bifurcated nation, not a soft landing, a split, winners and losers, and the losers are the markets where millions of Americans bought homes at peak prices between 2020 and 2022. Among the metros, Zillow flags for the steepest projected declines through March 2027. Houma, Louisiana at minus 7.0%, Lake Charles, Louisiana at minus 5.6%, Austin, Texas at minus 4.6%, and New Orleans at minus 4.4%. And those are just the forecasted future drops. They do not include the corrections already in progress.
New listings up 19% in March from a year ago, but it's really important to put that in context. Think about what that listing level looks like from pre-pandemic levels, from the norms when we were seeing 5.5 to 6 million homes trade every year. We're still 30-40% off those levels.
Zillow's March 2026 data showed Austin Round Rock home values already down 5.9% year over year, while Florida statewide home values were down 4.2% over the same period, and Tampa was down 3.5%. And Redfin confirmed in April 2026 that sellers in Texas and Florida were the most likely to cut prices among all 50 largest U.S. metro areas, with San Antonio, Austin, Dallas, Tampa, and Fort Lauderdale leading the price cut rankings. The cities already falling ground zero.
While the price of just about everything is going up, the price of your biggest asset is dropping. We're talking about your home's value. The average home value in our area has decreased by $10,000 over the last year. In Punta Gorda, home prices have declined more than $25,000. Experts say that trend is not over.
Let's go city by city because this is where it gets real. Cape Coral, Fort Myers, Florida. This is the most important market in America right now if you want to understand where the 35% scenario is already in motion on a local level. During the pandemic-era boom from 2020 to 2022, median sales prices in Southwest Florida rose by 12%, then 25%, then 20% in 3 consecutive years. Investors flooded in, remote workers arrived, prices exploded 70% from pre-pandemic levels. Now the hangover. The Cape Coral-Fort Myers region saw the sharpest price drop of any major U.S. city in Q1 2026, with median home sale prices falling 9% year over year to $341,250, according to Adam data.
Well, it's no secret that the value of homes here along the Gulf Coast have certainly declined. However, there is some good news in this story.
I know in Florida, the sales, the listings at least, have been up exponentially. Even just driving down here through Fort Myers, you see left and right, you see for sale signs everywhere.
But that annual figure understates the peak to trough reality. An analysis found home prices in Cape Coral-Fort Myers have dropped by roughly 10 to 11% over the last couple of years, with 52% of active listings experiencing price cuts. Cape Coral also has the highest percentage of homeowners underwater in the country, with nearly 8% of mortgage holders now owing more than their homes are worth. One documented example says everything. A property in Cape Coral purchased 3 years ago by an investor for Airbnb use, fully furnished with a pool, started at $675,000 asking price. It has since been slashed to under $500,000. More than $100,000 below the purchase price. This is what a 35% correction looks like in practice, not as a national statistic, but as a family's financial life.
Report shows Champaign, Illinois is the worst place in the country to sell a home, but it's the next 3 positions that affect us. Cape Coral coming in at number 2, Naples number 3, Punta Gorda 4th on the list.
I actually bought a year ago. It was right before they dropped. Now my property has devalued if I went to sell it today compared to what I bought it for.
Kathy Doman lives right in the middle of these cities that saw a 7% drop in home prices.
I would like to sell it eventually and get a larger place.
Austin, Texas. Austin spent 3 years as the poster child of the pandemic housing boom. Tech workers flooded in. Prices soared 73% from pre-pandemic levels. Everyone called it the next great American city. Austin's typical home value now sits at approximately $494,727 to $508,530, down roughly 3.6% to 5.9% year over year, depending on the data source and time frame. That sounds manageable until you factor in the full peak to now picture. Austin has already declined roughly 18 to 20% from its 2022 peak. And Zillow is forecasting an additional 4.6% decline through March 2027.
What are some of those hot markets for buyers right now?
The hottest markets are actually in the Midwest and in some of the smaller cities in the Northeast. These are markets that never really shot up in value during the pandemic. It's been more slow and steady. But now, because incomes are growing faster than home prices there, people are starting to get into the market even despite these high mortgage rates.
Add those numbers together, and you are already approaching a 25% correction from peak in one of America's most watched housing markets. Austin currently carries 128% more sellers than buyers. That figure is extraordinary. When sellers outnumber buyers by more than 2 to 1 in a market of that size, prices have only one direction to move. The AEI Housing Center confirmed in its April 2026 analysis that Austin is running the steepest correction among major metros, and there is no credible forecast showing a strong reversal anytime soon. Florida's Gulf Coast, the broader collapse. The problem in Florida is not just one city. It is structural, and it is spreading. According to Cotality data, the Florida FHFA House Price Index fell 2.3% year over year through Q3 2025, one of only a handful of states in negative territory, while the national index was still rising. Florida's condo market in particular is in outright distress, with 13.2 months of supply statewide, prices down 6.1% year over year, and 92% of major Florida condo markets declining. Tampa's Case-Shiller Index has posted 13 consecutive months of year-over-year declines. Other Florida cities experiencing price declines in early 2026 include Ocala, Lakeland Winter Haven, and the Naples-Immokalee-Marco Island area, according to CBS News. The American Enterprise Institute's April 2026 housing data showed Cape Coral leading all major U.S. metros with a 9.6% year-over-year price drop, followed by Northport, Palm Bay, and a sweep of Florida markets filling the bottom of the national rankings. All told, 28 out of America's 53 largest metros saw price decreases through February 2026, including every major metro in Florida and the entire state of Texas, Louisiana's Gulf Coast. If you want to see where the housing market's worst case is already playing out, Louisiana is the answer. Zillow's forecast shows HUMA, Louisiana facing the steepest projected decline of any tracked metro at minus 7.0% over the next year, with Lake Charles close behind at minus 5.6% and New Orleans at minus 4.4%. The mechanism is the same as Southwest Florida, but accelerated. A 1-2 punch of hurricane exposure, soaring insurance premiums, and buyers simply fleeing. Research describes the recent reinsurance repricing in coastal markets as a reinsurance shock that has already stripped tens of thousands of dollars from home values in high-risk zip codes. When insurance becomes unavailable or unaffordable, the math of owning a home stops working. And when the math stops working, buyers stop buying. And when buyers stop buying, prices fall. This is not a complicated story. It is just an uncomfortable one. The bifurcation nobody is talking about loudly enough. Here's the twist in all of this that is critical to understand for anyone watching this market. While the Sun Belt crumbles, the Rust Belt is booming. Detroit home prices jumped 17% to a median of $259,000 in Q1 2026. Kansas City rose 8.6%. Pittsburgh climbed 5.8%. Cleveland gained 5.9%. These are not glamour markets. They never were. And that is precisely why they never went through a 70% pandemic price surge that needed to be corrected back out. Zillow's updated forecast projects the strongest home price appreciation in markets like Syracuse, New York, Rockford, Illinois, and Rochester, New York, all affordable Midwest and Northeast markets where prices never got irrational in the first place. Fortune summarized this reality as follows. The formerly sizzling metros have gone cold, and the unsexy plotters are back in vogue. You could almost cut and paste the best performers from February 2022 into the current worst column and vice versa. This is the inverse of the pandemic trade. The markets everyone chased are now losing. The markets everyone ignored are now winning. And if you are sitting in a Sunbelt home you bought in 2021 waiting for the bounce back, the AEI is projecting not just further single-family price drops through 2026, but additional 2% declines in both 2027 and 2028. What the 35% math means for where you live. So let's bring this back to the number that started this video. Will any market actually see a full 35% drop from pandemic peaks? In some specific markets, the math is closer than people realize. A market that went up 70% from 2019 to 2022, then gives back 30% of that gain, still ends up roughly 20% above pre-pandemic levels. That is not a 35% drop from today's prices, but it is a 30% drop from peak. And in a market like Cape Coral, Punta Gorda, or Naples, that is where the numbers are pointing when you stack the already realized correction on top of Zillow's forward projections. Catality confirmed that in December 2025, nearly half of all U.S. metropolitan areas experienced an uptick in overall delinquencies, serious delinquencies, and foreclosures, even as the national headline number looked calm. Those local pockets of distress become inventory. That inventory becomes supply. That supply, in markets where buyers have already thinned out, becomes price pressure. The 35% needed nationally is a mathematical impossibility in the short term. But city by city, neighborhood by neighborhood, it is not a warning anymore. It is a process. In 309 metro areas across America, according to Zillow's own data, that process has already begun. What you should actually do right now. If you own a home in a Sunbelt or Gulf Coast market that surged during the pandemic, this is not the moment to panic. It is the moment to be clear-eyed. Understand your peak to now decline. Pull the Zillow Home Value Index for your specific city. Know your number. If you are 15% off peak with more Zillow projected declines coming over the next 12 months, your equity situation looks different than it did 2 years ago. If you are thinking of selling, the data from across Florida and Texas is consistent. Sellers who price competitively from day one are selling. Sellers who anchor to 2022 comparables are sitting on the market for 84 plus days with forced price cuts. And if you are thinking of buying in one of these declining markets, take your time. With 46.3% more sellers than buyers nationally, according to Redfin's February 2026 data, you have leverage that buyers have not had since before the pandemic. Use it. The 35% number was always the uncomfortable truth sitting behind 5 years of housing only goes up. In 309 cities across America, the market is starting to tell you that truth whether the industry wants to say it or not.